Hello, I'm Emma-Lou Montgomery. Welcome to the January Investment Outlook webcast. Joining us today, of course, is report author and Fidelity Investment Director, Tom Stevenson. Hello, Tom.
Hi, Emma-Lou.
Now, this is the very first webcast of 2021. The big question is, of course, what's in store for us? Already, I think it's safe to say the year's begun a little differently to how we might have hoped, raising plenty of questions about how the year might unfold. We've continued to deal with extraordinary events and a great deal of uncertainty for the best part of a year now. Yet the pandemic and even Brexit as we go into 2021 are still dominating. Now, Tom, uncertainty, as I say, has been a theme in these webcasts as well for some time now. But how tricky does that make it to look ahead to the next 12 months at this point in time?
Yeah, I think it is a tricky year. I mean, you go back to this time last year, obviously we had no idea what was about to hit us in terms of the pandemic, but in other ways, we did have a sort of sense of what was coming down the track. We knew there were some known unknowns, if you like. We knew that the US election was on its way. We knew that Brexit talks would last throughout the year and that we would be leaving the EU at the end of the year. So in some ways, we had a structure for the year, which we don't have the benefit of this year. It is more of a blank canvas as we look into 2021.
Should be interesting then. Just a quick reminder that these are Tom's views of the market, so they shouldn't be taken as investment advice, but just as guidance. Now, we're about to hear Tom's analysis of the global markets and the key asset classes over the next 12 months. But this is, of course, also an opportunity for you to ask your questions. We aren't taking questions live during this webcast, but we did ask you to submit your questions in advance. And as usual, I'm pleased to say so many of you have done just that. Now, just before we get to those and hear Tom's views, let's hear his views, first of all, on the current outlook for investors.
Well, 2020 was a strange mixture, miserable in many ways and plain boring at times. It will go down in the financial history books as not a bad year for investors. The S&P 500 rose 16% from start to finish. What that doesn't show, of course, is that in between times, it fell 44%. February and March saw one of the fastest bear markets ever. You can see that picture clearly in the V-shaped chart here. Ignore the volatility in the middle and you'd probably conclude that 2019 and 2020 put together were a great two-year period to be in the markets. This is the MSCI World Index of global shares. If you'd backed the technology winners in the US, you'd have done even better. But there were plenty of other places to make money too. Here you can see the Chinese market tracking the US in both directions last year. The reasons were different, but the outcome much the same. China was first in and first out of the pandemic. America was in favor more because it represented a defensive growth market in a uniquely difficult period. A key question then is whether investors have pushed markets too far, too fast. Here you can see how valuations have returned to levels that we last saw during the dot-com bubble in the late 1990s. Hopefully, rising corporate earnings will bring those multiples down as quickly as they shot up while earnings were falling. But clearly, they need to if markets are to hang on to today's elevated levels. These have been interesting times, and those always provide plenty of lessons. I set out 5 that jumped out at me last year in this quarter's outlook, so do take a look after this webcast. A key learning for me was how sometimes the obvious trade is the right one. The outperformance of technology stocks, shown clearly in this chart, was not rocket science, but backing the stay-at-home winners and avoiding the hospitality and retail stocks that suffered most in the pandemic will have served you well, even long after that view became the conventional wisdom. At this time of year, I like to set out my fun picks for the year ahead and to review the ones I made 12 months ago. I do this with some trepidation for good reason. Who would have predicted a year ago what lay in store? In the end, my 4 picks did okay in the circumstances. I entered 2020 in a moderately cautious frame of mind, and that paid off. The more defensive picks, Fidelity Global Dividend and Fidelity Select 50 Balanced, recouped their losses and a bit more. That just about made up for the underperformance of Lion Trust UK Growth, I was too early, and Artemis Global Emerging Markets, ditto. This year, I'm looking to play 3 key themes. Sustainability is on every investor's radar, And the smart money has realized that doing good is not incompatible with making money, as the performance of renewable energy stocks here shows. On the contrary, scoring highly on environmental, social, and governance factors is a kind of shorthand for overall business and management quality. That's why I've picked the Brown Advisory US Sustainable Growth Fund and the Stewart Investors Asia Pacific Leaders Sustainability Fund. Both are looking for socially useful businesses with a sustainable business advantage. I hope they'll both do well. Another key theme is income, with governments and central banks looking to keep the stimulus going this year. Even as recovery kicks in, interest rates will stay low for the foreseeable future, and finding yield will be a challenge. Moving into alternative income sources via the Foresight UK Infrastructure Fund might be one solution. The third theme I'm playing this year is the UK's post-Brexit catch-up. A pariah market for many years, the UK is now excessively cheap. It's a potentially big beneficiary of post-COVID recovery, and with luck, we can stop arguing with ourselves now and get on with chasing that global Britain dream we were promised nearly 5 years ago. I've picked two funds from the UK, both from Fidelity, Special Situations and UK Select, to cover off both the growth and value investing styles. This chart shows why I've chosen both styles. Growth has outperformed for many years now, and a big economic recovery might well trigger a rotation back to cyclical value. Or it might not. There have been plenty of false dawns in the past. So a bit of both is the sensible fence-sitting solution. Okay, let's spin through the main asset classes now, starting with shares. The chart here shows how the V-shaped rally has been very different from the long grind of the post-financial crisis bear market. For now, I think the market is right to be optimistic about the speed of recovery once the vaccines are rolled out. Add in continuing stimulus and valuations which are full but not excessive, and I think shares remain the place to be. Of course, there are risks, but I don't see why 2021 shouldn't be a decent year in the stock market as recovery takes hold. The main alternative to shares, bonds, had a pretty good year in 2020, but it feels like they're running out of road. Yields fell early in the pandemic as interest rates were slashed again, but there's nowhere for rates to go now that central banks have lost their appetite for deeper forays below zero. Of course, there's more to bonds than developed country government paper, and there remain pockets of income, such as from the Chinese government bonds shown here in blue. Some corporates offer value too. Commodities have been the Cinderella asset class over the past decade or so. Looking forward, however, a combination of underinvestment in productive capacity and a desire to build back better, not to mention China's early emergence from the pandemic, could argue for a renewed bull market in industrial metals. The outlook is cloudier for energy as the world looks to shift to more sustainable sources. Gold, meanwhile, looks interesting as the threat of inflation increases. The past year has been a challenging one for the commercial property sector. The chart here shows one reason why. Office demand has slumped as many of us have shifted to working from home. Meanwhile, the outlook for retail, which was grim anyway, thanks to the move to online shopping, has got a whole lot worse in the past year. The good news for property investors is that the asset class continues to offer income in a yield-hungry world, and many investors will continue to like the ability to reach out and touch their investments. So let's finish up with a quick spin round the main regions, beginning with our own, the much maligned UK stock market. The time to get interested in any investment is when most people think you're mad to be even considering it. The UK fits this description well. A pariah in the investment world, London has had the mark of Brexit for half a decade now. Just compare this chart with the one I showed earlier of the MSCI World's V-shaped recovery. Now, I think, is the moment to consider the UK again. It's cheap. Brexit is in the past at last. We have political stability, an independent central bank, our own currency, some world-leading businesses. There really is a price for everything. Here's a stock for which no price seems too high right now. Tesla is an extreme example, but it illustrates how technology has been the major driver of the US market's massive outperformance, not just in 2020, but for many years. Has Wall Street gone too far? Not if you believe Goldman Sachs, a raging bull, it has to be said, which has penciled in 4,300 for the S&P 500 this year and 4,600 in 2022. If there's a stimulus and recovery fueled rally this year, then I wouldn't want to be out of the US market. So, pricey as it is, America stays in my portfolio for now. But the US is not the only game in town this year. First in and first out of the pandemic, Asia has held its own and has the advantage of still being relatively cheap. This chart shows China and India neck and neck with the US last year, and many market watchers see 2021 being the year of emerging markets generally. They're well placed to benefit from a general uptick in economic activity, and a falling dollar could be the icing on the cake. Europe has been at the epicenter of the pandemic, and second wave shutdowns continue to dog its economic outlook. Corporate earnings are likely to be marked down as a result, and that raises doubts too about the strength of the expected bounce in 2021. That's the main concern. On the other side of the ledger, the ECB has shown its willingness to continue providing stimulus, and a trade deal with the UK will help too. Valuations are not high either. Which just leaves Japan, desperately hoping to host the delayed Olympics in 2021. We shall see. As the chart here shows, the pandemic came at a bad time for Japan. It was in a good place as 2020 began, with a buoyant jobs market and the fruits of 8 years of Abenomics starting to be harvested. Like the UK and Europe, Japan is not well loved as a market. It's cheap, it's exposed to global recovery, and it's suffered heavy outflows. Okay, we've said this before, but it's a good contrarian opportunity.
Okay, welcome back. Now, let's get started with the questions, Tom, shall we? Right, first one. Given Brexit is done and the vaccines are now being rolled out, and with the limitations of the FTSE 100, finance, oils, mining, etc., should the equities percentage of a medium risk balanced portfolio be weighted towards global equity funds rather than just UK equity funds?
Okay, that's an interesting question. I mean, I think not is the short answer. For a long time, we've been pretty cautious about the UK, and investors certainly have been against the UK in sentiment terms. I think that's beginning to change now. I think getting the Brexit situation out of the way could be the key to unlock the future. Now, obviously, I think with the third lockdown, which we've just gone into, I think that possibly pushes back the recovery in the UK market. I don't think it reduces the strength of the recovery when it comes, but I do think it pushes back. But I think there's lots to say in favour of investing in the UK at the moment. It's a beneficiary of coming out of the pandemic. The economy is geared to sectors which have been hit badly by the pandemic, and I think as we come out, we will recover pretty strongly. And in terms of valuations, as I say, sentiment has been against the UK, and therefore valuations are pretty low in the UK. So I actually would favour a slightly higher weighting towards the UK than in the past. So yes, sure, a global portfolio makes sense to have that global approach, but I think within that, the UK should be a slightly higher proportion than it has been more recently.
Okay, we've got quite a few questions actually asking about whether the unloved UK should be looked at right now. This question asks, or raises the interesting point, of course, about how FTSE 100 companies actually get their money. So it says, what is the outlook for FTSE 100 companies given Brexit? From what I understand, the major FTSE players are international generally and trade in dollars, so aren't affected or aren't meant to be affected badly by the initial years following Brexit.
Yeah, I mean, I think that that's true, that the FTSE 100 is an international facing market, and therefore what's going on in the global economy is as important or more important than the Brexit situation. But clearly, Europe is a big trading partner of the UK. So getting that trade deal in place is a help for FTSE 100 companies and the smaller companies in the 250 and the small cap as well. But I think more important is what's going on, excuse me, with the pandemic, with the vaccination program, with the recovery from the situation that we had last year. So a combination of the two, a combination of Brexit being resolved and coming out of the pandemic, I think is a good combination for the FTSE 100.
Okay. Now, of course, equities aren't the only assets to look at here. Bonds, we've got lots and lots of questions about bonds. So the first question here is saying, is the traditional 60-40 equity bond split now outdated and inappropriate?
Yeah, so I've addressed this actually in the outlook. I do think that the old idea behind a 60-40 split of having 60% equities and 40% bonds is maybe less appropriate than it has been in the past. I think that with interest rates at rock bottom and really not able to go any lower, with central banks having made it clear that they're not really interested in going further down into negative territory, I think the potential for bonds to offset weakness in the equity market, so to be a counterbalancing force for investors, is less clear than it was before. And so I think with interest rates low, with bond yields low, the reason for holding bonds is less obvious now. And I think at the margin, some of the money that is parked in bonds is going to move into the equity market. So I'm actually, less keen on bonds as a balancing factor in a diversified portfolio than I have been in the past. And that's why I think that equities are actually the place to be this year.
Okay. Another question for you here on currencies. How important are currency fluctuations going to be in 2021? And should they be a major factor in asset allocation?
Well, I think currencies are an important factor. And I think they're going to be particularly interesting this year because I think, with interest rates so low in the US, with the deficit so high in the US and likely to get higher, and we've seen with the result in Georgia, I think the prospect of more government spending in the US is higher today than it was even yesterday. I think that's going to have a downward impact on the dollar. So I think currencies will be important. How you actually play that as an investor is another matter altogether, because currency movements are so unpredictable, and they do tend to come out in the wash actually. So when I've tried to play currencies in this way in the past, I found it very, very difficult. So I think that it's more important to be well diversified, to be well spread across different currency exposures, but just to let that play itself, if you like, and not try and be too clever about currencies.
Okay, let's move on to cryptocurrencies then. So I've got one here for you. Hello, Tom, and a happy new year. I'd like to ask, when do you think cryptocurrencies will become legitimate investments, as returns are already very good if you take care? Your views on these would be very interesting. Thank you.
Yes, well, taking care is the key point with cryptocurrencies. I mean, if you think that currencies are hard to judge where they're going, then the outlook for cryptocurrencies, Bitcoin, is even more complex. Now, we've seen in the last 3 months or so that the price of Bitcoin has soared. I mean, it's up about threefold since last summer, which of course is generating a lot of interest. And I think that the first part of the question was about it becoming a legitimate investment class. I think that is starting to happen. I think serious investors are looking at cryptocurrencies, at Bitcoin, and trying to understand what's going on there. But it is an unregulated market. It's very difficult to value Bitcoin. People see it as an alternative store of value, a kind of digital gold, if you like, and there is some merit in that argument. But I think we've got a lot of learning to do before we really think of Bitcoin cryptocurrencies as a significant part of our overall portfolios.
Okay. Now, emerging markets are part of many people's portfolios. Question here saying, what do you see as the outlook for emerging markets in the coming year? And should this influence the weighting of emerging markets in your portfolio?
Yeah, I think the outlook for emerging markets is pretty good this year. I think the ongoing structural argument for investing in Asia and other emerging markets is strong. I think the outlook for commodities, which we haven't talked about yet, is pretty positive, and commodities are an important driver of many emerging markets. We talked about the dollar. A weakening dollar tends to help emerging markets too. So for a number of reasons, the final reason, I guess, is that China and other North Asian countries, South Korea, for example, they were first in, they're first out of the pandemic. So I think that there's a sort of tactical reason why they look interesting as well. So I think for a number of different reasons, emerging markets look like an interesting place to be in 2021.
Okay, world of opportunity out there. So this next question would be interesting to get your views on. It says, hi, Tom, always value your insights.
Thank you.
Much stock is rightly given to being diversified, but what are your views on a sensible 2021 geographical weighting within a fund portfolio, particularly in relation to percentage holdings for, say, UK, Europe, US, Japan, Asia, and global?
Yeah, well, I mean, and I address that question in the outlook. So so please do go and read the outlook. I mean, I talk about all of those regions. It does feel a bit different this year. I've talked about the UK. I think the UK probably bumps up a little bit. If you look at the weightings in terms of market capitalization of the global market, then somewhere like the UK, it's probably only about 6%. You probably want a bit more than that in a portfolio, let's say 10 to 15, approximately. The US represents about 50% of the global market. So whatever you think about the US, and it is the most highly valued market, the most expensive market, it's the most geared to sort of growth stock investing, technology, those kinds of sectors which have done very well. So you might be a bit cautious about it. But representing 50% of the value of the global stock market, you're always going to have an exposure to the US. It might be a bit less than 50%, to be honest. So I'd slightly underweight the US. I'd slightly overweight the UK. I'd overweight emerging markets. Europe and Japan are probably roughly in line with their market cap weightings.
Okay, so the next question was going to be, will the US market lead the way yet again, or is the Far East going to become much more dominant? And also another question saying, what are your views on Japan? Is that still a good place to invest? But you've kind of...
Yeah, okay. So I mean, let's start with the US there. It has led the way for so long. I think the odds are against it continuing to lead the way. However, if the recovery from the COVID situation is a bit slower, then a lot of expectations have been baked into the stock market, and if those expectations are disappointed, then investors are going to move towards safety, safe havens, and that probably means they're going to go back to the kinds of growthy tech focused areas of the US market which have done so well. So for that reason, I would be careful about moving too rapidly away from the US at the moment. It feels like a safe haven market to be in.
Okay, and Japan, any particular views on whether that's a hot territory still?
Yeah, so Japan is, a bit like Europe, a bit like the UK. It's been out of favor. It is very highly geared to a general recovery in the global economy. It's a big exporting economy, got a lot of overseas earners there. So I think if we do get a pickup, which I think we should anticipate that there will be a pretty sharp pickup in economic activity as we pull out of the pandemic, then I think Japan looks okay. It's got a new government there, which looks like it's building on the gains of the Abenomics program. So I think, and its share market is not expensive. So I think there's quite a lot to say for Japan as well.
Okay. Now we always get lots of questions, don't we, on how people who've got pensions, can sort of provide themselves some kind of regular income, and also the levels of risk and weighing up the sort of pros and cons there. So I've got quite a lengthy question here for you from somebody saying, some investors insist on regular income to supplement their pension, yet bond funds are not so attractive at the moment, given current low yields and relatively high prices. You want to protect your money by not taking on too much risk in search of a relatively higher yield. But if and when interest rates start to creep up, then bond prices should go down to the detriment of those holding these sort of bonds. What's your recommendation in this difficult situation?
Yeah, there's some interesting points in that question. I think that bonds. Well, first of all, it's difficult to generalize about bonds because there are lots of different types of bonds, and it's certainly true that if interest rates do start to creep up, then government bonds, which are largely determined by interest rates, are likely to fall in value. There are other parts of the bond market, corporate bonds, high yield bonds, investment grade bonds, and also some emerging market government bonds. So I highlight in the report actually Chinese government bonds, which are yielding about 3.5% at the moment. So much more, about 2.5 percentage points more than the equivalent in the US. So you can still get income from bonds, but I think you probably need to look more widely. One of my recommendations, one of my fund picks this year is the Foresight Infrastructure Income Fund, UK Income Fund. So that is that's a fund which invests in real assets, infrastructure assets, some sort of renewable energy assets, those kinds of things, to deliver an income. So there's infrastructure, there's bonds, there's even real estate, which is out of favor at the moment, but it still delivers an income. So I think look for a diversified income stream is what I would recommend.
Okay, and now, of course, another issue that always concerns people who are, trying to protect or grow an income is the threat of inflation. Question here saying, how much of a threat is inflation in the next, say, year and the next couple of years after that?
Yeah, I mean, inflation is increasingly coming on investors' radars. You look at what government and central bank policy has been flooding the market with liquidity. You have to think that in time that is going to generate more inflation. And so I think we should be worried about it, but maybe not immediately. I mean, I think that the downward pull on inflation of the economic problems that we're facing through the pandemic means that there is no sign of inflation just yet. But I think we should be aware of it, down the track. But we're probably looking 1 to 2 and further out years than that.
Okay. Question here for you, Tom. Hi, Tom. Best wishes for the new year. What time frame do you anticipate a rotation towards value stocks to occur in? Or do you think growth stocks will still be doing well over the next 12 to 18 months?
Yeah, one of the key questions for the next 12 months. And again, I talk about this in the outlook. I think that the evidence is that we will get some kind of a rotation back towards value stocks. In order for that to happen, we need to have a pickup in the economy. We'll need to have bond yields rising, maybe a return of some kind of inflation. If we get that kind of combination, then out of favor, lowly valued stocks which are geared to an economic recovery will probably do well, and the growth stocks, the defensive stocks in which investors have sort of sheltered for so long will become relatively less appealing, especially if interest rates and bond yields start to rise. Will that happen in the next year? Possibly. And when it does happen, when you get a rotation into value, it tends to happen quite quickly. So you've got to be prepared for it. And I think the way to be prepared for it is to have a nice balance of, growth focused funds, but also value funds. So I was talking earlier on about my recommendations, my fund recommendations. Within the UK, I've deliberately gone for two funds. One is a contrarian value focused fund, the Special Situations Fund. The other one is much more of a growth focused fund, the UK Select Fund. And I've done it deliberately because I simply don't know when this rotation is going to happen and the extent to which it's going to happen. So I think balancing your portfolio with both is the only sensible approach at the moment.
Okay, so another issue that investors are also considering, we haven't talked about yet, is sustainability. So I've got a question here for you on those lines. So my wife and I are saving for the short to medium term, say 6 to 8 years. We feel a moral duty to move our investments to ESG responsible funds. However, the short-term returns appear to be questionable. What's your view and advice here, Tom?
Well, I think that's an interesting observation and I'm not sure that I completely agree with it, because the evidence from our analysis, here within Fidelity, is that companies which score highly on environmental and social and governance factors, so these sustainability factors, which everyone is talking about at the moment and considering as investors, companies that score highly on those factors tend to do better, actually, because scoring highly on those factors is a kind of proxy for good management, good business, good quality. And I think, so it doesn't surprise me that they tend to do better. So I think the evidence is actually that you can do the right thing. We talked about, the questioner talked about a moral imperative to do the right thing. I totally agree with that. I don't think it's necessarily incompatible with getting a good return. In fact, I think the reverse is true. I think that by going for those things, by focusing on those things, you actually stack the odds in your favor of getting a good return.
Okay. Next one for you, Tom. It says, hi, Tom. I'm setting up a women's investment group of 6 friends wanting to learn more and invest our money in a long-term project that will hopefully span decades. Is now a good time to start such a group fund, or is it a terrible time? What would you advise?
Well, I think the interesting part about that question is this idea that hopefully it will last for decades. That's the key thing, I think. So then that kind of answers the second part about, is this a good or a bad time? It doesn't really matter whether this is a good or a bad time, because if you're looking at an investment time horizon of decades, then it will all come out in the wash. And absolutely, now is a good time to be thinking about that. So good luck. I'm really encouraged by that.
Great. So it says, in a recent briefing, you counseled that investors should stay alert. In practical terms, what does an investor do to stay alert, and what steps should an investor take in a bear market?
Yeah, well, that's interesting. I don't remember using that. I thought it was Boris Johnson that told us to stay alert. But he's right. We should all stay alert as investors. Well, I mean, the best way of doing it, of course, is to stay tuned into events like this, and to check in with our website, to keep abreast of what's going on. And I think a key part of staying alert is staying diversified, because we don't know what's around the corner. We don't know what's going to do well, what's not going to do well. So, you can't keep on top of everything, and you need to protect yourself from the unknown. And the way to do that is to be well diversified.
Okay. Another one for you here, Tom. Right. So, Tom, happy New Year to you. Oh, I like that. Happy New Year. I'm a 73-year-old male in good health with savings stuck in useless, percentage-wise terms, cash ISAs. While I foresee no need for these savings in the foreseeable future, I have been worried about moving into stocks and shares ISAs during these uncertain times. My instinct tells me that with careful choice, I must be able to get better returns elsewhere, even though at 73, I'm looking at over the next 5 years, say. Any suggestions?
Well, I mean, my instinct is to agree with you. I think that, clearly cash is not the place for long-term holdings, or even, maybe less than 5 years, it is the place. But, for 5 years or more, then clearly you want to be looking for better returns than you're going to get from cash. And, there is no prospect of the returns from cash improving any time soon. We know that governments are going to continue to try and stimulate the economy with low interest rates, bond yields, all sorts of all returns are going to be low in that environment. So you need to push further up the risk spectrum to get returns. But come back to what I say all the time. Make sure that you protect yourself in that environment by being balanced across different asset classes, across different geographies, and keep some cash, because look back to 2020. If you'd not had any cash in March, April, when the market bottomed, you'd have been unable to benefit from the pickup in markets that we saw in the rest of the year. So cash does have a function, but it just isn't yield. That's not what cash offers at the moment. What it offers is flexibility.
Okay. And Tom, one final thought from me, if I can get that. What do you see as a safe haven in 2021, if indeed such a thing even exists?
Yes, I think that the traditional safe havens are probably less safe than they were. So people think of bonds as being safer than equities. Safe as houses, property. I think actually the safest haven is probably to lock yourself into the ongoing growth in the global economy, and the best way to do that really is through the equity market. And that's why my conclusion in the outlook is that shares continue to be the asset class of choice this year.
Tom, as always, thank you so much. And thank you as well for joining us today. I hope you've gleaned some insights and we've managed to answer some of your questions. If we didn't get round to yours, then we have a special edition of the Money Talk Radio podcast hosted by Ed Monk. Tom will be joining him to talk through the questions we haven't had time to cover just now. And you can listen to that on iTunes or wherever you usually get your podcasts. Don't forget too that a full copy of Tom's investment outlook is also available to download here at fidelity.co.uk. Thank you again for watching. Do join us again next time. Bye for now.